In this video, we're going to be performing a deep dive on Texas Instruments Dividend Safety. To begin, let's talk about Texas Instruments' business model. Texas Instruments is a semiconductor company that operates in two business units, analog and embedded processing. Its products include semiconductors that measure sound, temperature, and other physical data and convert them to digital signals, as well as semiconductors that are designed to handle specific tasks and applications. Texas Instruments was founded in 1930, is headquartered in Dallas, Texas, and currently trades with a market capitalization of $90 billion. Texas Instruments is a well-known dividend stock because of its compelling track record of dividend growth. With 14 years of consecutive dividend increases, Texas Instruments is a member of the Dividend Achievers Index, a group of elite dividend stocks with more than 10 years of consecutive dividend increases. Texas Instruments' high dividend yield may lead some investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Texas Instruments' dividend safety in the context of the company's current earnings. When Texas Instruments reported its third quarter financial results on October 23rd, the company provided updated financial guidance for the full fiscal year. Texas Instruments expects to generate earnings per share of approximately $5.57 in fiscal 2018. For context, Texas Instruments currently pays a quarterly dividend of 77 cents per share, which implies a payout ratio of just 55%. Using earnings, Texas Instruments' dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Texas Instruments' current dividend payment to its free cash flow. Through the trailing 12 months that ended September 30th, 2018, Texas Instruments generated free cash flow of $4.25 billion. During the same time period, the company spent $2.43 billion on dividend payments for a free cash flow dividend payout ratio of 57%. Using free cash flow, our conclusion is the same as when we used earnings to measure Texas Instruments' dividend safety. The company's dividend appears safe for the foreseeable future, and its payout ratio using free cash flow is actually lower than the earnings per share equivalent. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Texas Instruments' current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Texas Instruments' performance during this time period is shown here. Texas Instruments' earnings per share were surprisingly volatile during the 2007 to 2009 financial crisis. The company's earnings declined by 37% during the worst of the recession. With that said, Texas Instruments' current dividend payment would still be covered by earnings if its earnings experienced a similar 37% decline today. Moreover, the company's dividend was covered during each year of the last economic contraction. Because of this, we believe that Texas Instruments' dividend is unlikely to be reduced during future short-term contractions in economic activity. The last angle that we will use to assess Texas Instruments' current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. At the end of the most recent reporting period, Texas Instruments had $5.07 billion of debt outstanding. The company generated $36 million of interest expense during the same time period, which is equivalent to an annualized interest rate of 2.8%. The following image shows how changes to Texas Instruments' weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Texas Instruments' weighted average interest rate would need to rise to above the 20% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that Texas Instruments' debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Texas Instruments' current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you are interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.